Let's welcome David Kelly, Chief Global Strategist at JPMorgan Asset Management, Katie Nixon, Chief Investment Officer at Northern Trust Wealth Management, and Jim Caron, Global Fixed Income Portfolio Manager at Morgan Stanley Investment Management. Got a lot of brain power here. David Kelly, I remember when we began this cycle, I forget whether it was April or May or whenever, you said something that is stuck in my head, that the typical problem with Fed policy is that they, under these circumstances, is they start too late, they go too high, and they stay there too long. Is that still your fear?
Yeah, absolutely. The Fed, I think, will raise rates 75 basis points today. But the problem is, I think in his comments, Chairman Powell is going to still sound very hawkish and really pave the way for another 75 basis point hike in November. And this path is too much. This economy is slowing down to a crawl. Inflation is going to roll over anyway, maybe not as fast as the Fed would like. But I think the Fed is in grave danger of tipping this economy into recession by being more hawkish than they need to be right now. Jim Caron, what do you say? You agree?
Well, I think Dave brings up some really good points. The thing is that the Fed is behind the curve, and that we all know that monetary policy works with a lag, and we have to try to figure out when they're going too far. But right now, we see inflation pressures as really topping, but also broadening out. So I think they have a lot more work to do and are very likely to sound hawkish and probably signal another 75 basis point move again at the next meeting.
Katie, the rapid rise in the two-year note, now above 4%, what does that tell you about how investors are positioned ahead of the decision?
Seema, investors are expecting 75 basis points, and I think investors are expecting the kind of scenario that's been outlined by the prior two guests. The Fed's going to hike further than we had thought and going to stay there for a little bit longer than we thought as well. So I think investors are positioning for that. But what you see in the yield curve is interesting, which is investors are also coming around to the fact that this is going to slow down the economy. So you've got this inversion, you've got this problem in the yield curve that's reflecting a lot of uncertainty about the economic outlook. So we're going to have to deal with that next year.
Jim, I'm going to come back to you because David is worried that the Fed may go too far and stay there too long and really damage the economy. You seem to have a more nuanced view of that. I've got 45 seconds. Explain why you are less worried about the economy, seemingly, than David is. Quickly.
Well, I think that we're likely to have a mild recession. There's no question about that. It's just the idea, though, is that the labor market is as strong as it is. It's very hard to have a deep, protracted recession when the labor market is so strong. So it's not that the Fed won't hike rates too far and keep them there for too long. They probably will. It's just a question of how much of an impact does that have on the broader economy, and how much of a recession most likely does that cause, and how deep will that recession actually be. And I'm in the camp that it might be a little bit more on the mild side, even if we have one.
Right. Well, we are in a complicated time, both in terms of the economy, in terms of geopolitics, and the rest.